Wealth management is more than just investing. In fact, management today should involve investing, keeping in mind risk aversion returns. And that art has developed into a science of investing, taxation, estate planning, as well as philanthropy. We here at the Investing Edge, we aim at educating you and giving you a comprehensive analysis in terms of wealth management. I'm Nigel D'Souza, and with me today is Mr. Anand Rathi, the chairman of the Anand Rathi Group, as well as Feroze Azeez, the Deputy CEO at Anand Rathi Financial Services. I'll take the opportunity, Mr. Rathi,
please.
to ask you actually the first question.
All right.
Because maybe in 2008, 2009, I would be doing my master's at that time.
Yeah.
And I'm glad I didn't see the Southeast Asian crisis, because that was quite terrible, I believe, in the late 1990s. But today, everyone's so scared. Everyone's saying that things are coming to an end. How bad is the economy? Auto sales are not good. GDP at 6-year lows. You've seen many cycles like this, right? What would your advice be out there to a lot of our big investors out here? Because ultimately, things catch up, and you do make money if you're patient, isn't it?
Yes. I think very, very important issue is raised in the today's context, in the present context. There is a lot of fear in the minds of people. And for right reasons. Nothing wrong about it, because the GDP rate has gone down. Talk to any businessman, is not happy. The thing is, I'm not doing well. And as you rightly said, we have seen such cycles. I think many people sitting here must have seen the cycles which I have seen in my life. The cycles do come, and there are reasons behind it, okay? And what one should do is to look at the reasons, why it has happened, and whether these reasons are going to last forever. I think, obviously, my belief is that the present situation has come primarily because of 2-3 reasons. One, obviously, is the liquidity in the market has been sucked. And it's not 1-year game, 2-year game, it is last 5 years we have seen the Reserve Bank doing 2 things, taking the liquidity out and increasing the interest rates. And obviously, interest rate is the critical part of any economy. Higher the interest rate, it affects the consumption, it affects investment. So there is a cumulative effect of the liquidity being sucked and interest rates being increased. Obviously, second is there is a global, till 2 years back, the global economy was doing very well. Again, we have seen signs of global economy coming down. So there have been reasons for the present situation to come. But I believe that, when things are bad, we become pessimistic. Yeah. By nature, we see, the bad news always come first. The good news are always hidden, or they don't come at all. I think in this scenario, you can see a lot of good news. What are the good news to see today? The interest rates are falling. Which is, in any economy where interest rates go down, it will help increasing consumption, increasing investments, obviously. The liquidity is improving. The inflation rates are low, basically. So I think, once the cycle turns of liquidity, like you said, automobile today, there have been various reasons. One of the main reasons was that NBFC, problems.
Right.
The NBFC were not getting the finance. And once the fear comes in the market, everybody becomes risk averse. And you can see that today liquidity is there in the entire system. The banks have more than 2 lakh crores liquidity which they've deposited in the Reserve Bank of India. They are not lending because of the fear. Right. The fear of, because NPS has gone up, there's so much of media thing. The government has also been, after banking system for NPS. I'm sure that the situation is being realized by the government. If you have seen the last 2-3 weeks, there is some instance which tells that government is appreciating the problems and they're looking forward to the problems. I believe that what we are going is a cyclical time. It will take 6 months to 12 months to bring it back.
Well, Feroze, coming across to you then, no matter how much you perform in terms of, your fund performance or the returns you give, investors, they still seem very skeptical. How would you convince a lot of investors out there to stay the course, particularly with regard to mutual fund performance? Because of late, it hasn't been very, very great.
Correct. So if you look at how you look at an individual product, right? So in my opinion, the biggest learning in times like these is to have a strategy in place. A strategy is a composition of different financial instruments working towards an objective. A product, mutual fund is not doing well. Of course, it's been one of the worst 3-year periods in terms of active management. Fund managers who are supposed to give you more than the market have given you less than the market. Is it the best phase of the mutual fund industry? The answer is no. 98% of the 457 equity mutual funds have underperformed their respective benchmarks. But if that was your only bet, then there's a big problem. Now you need to have a plan A, you need to have a plan B. Most people, when they create the portfolio, they only have plan A, plan A1, plan A2. You need complementing products. One learning I would certainly ask you to follow is, do I have a strategy? Second learning, this learning I had after 2008. Understanding the 5 types of risk is your duty. It is not a good to have. It is a need to have. Third, you should use risk management tools like LEAPs. In India, LEAPs are available for the last 11 years. LEAPs are instruments which can protect your portfolio. It is like an insurance on the market. Understanding it and applying it when you're worried, okay, is very important. So these are the 2-3 things. If you took home, then I'm not worried about mutual fund. 39% of my strategy is equity mutual fund.
Well, Mr. Rathi, let's come across to you. And I'm sure, a lot of investors out there would like to know, if they have a portfolio, what should their view be on real estate, on gold? Those were the assets in the past that, my parents kept telling me that it was good. That was years ago. In the last few years, it hasn't done much. And suddenly this year, gold at least has given some returns. So, I mean, you would have seen gold as an asset class for very long.
Yes. I think let's first talk of real estate, because the large part of our portfolio across the clients you have seen is real estate. And in India, I believe it's more than 60%. That's too skewed. Now, how will real estate do? Obviously, our view for last 4-5 years that the real estate will not do very well. And there have been reasons for it, I think 2-3 reasons only I'll share with it. One is that when real estate prices have gone too high compared to the income, levels, there's always a relationship between the income levels and the real estate prices. And when one of them runs too fast, then obviously, the scope of growth goes down. So between 2003-4 to 2010-11 or 12, the real estate prices really zoomed much faster. And therefore, today the problem is affordability. It's not that India, there is no housing demand. People need houses. But then it has become unaffordable. The prices have risen too high. The second, we are, now opposed to horizontal growth of real estate, we are going vertical. And therefore, if you have 50-story buildings, 30-story buildings, the need of land obviously comes down. Yeah. And therefore, earlier, 30 years back, nobody said, I don't want to go in a flat, except in a place like Bombay. People wanted to have their own house, I think things are changing. And therefore, our view is that 2 major reasons will not allow real estate to grow. And particularly, as, Feroze said, the house which you are staying in is not your wealth, is not real estate, it's a consumption. But if you have 3 more houses or 2 more lands, obviously, I think you are all aware now, I don't have to tell. 3 years back, 4 years back, I found it difficult to convince people that real estate is not a good investment to continue. But today, everybody knows, and people now realize that it is not going to go far. So our advice to people is, even today, it's worth converting real estate into the financial assets. As far as gold is concerned, traditionally gold is, they say they have a measure of value, it retains the inflation. If you see last 30 years returns, the gold has given about inflation, which is the government explained inflation. About 8%, 9% return has come in gold. I think in difficult times, gold keeping 5% to 10% of investment in gold could be a good idea. But obviously, that's giving more satisfaction. Again, The gold which you buy for consumption is not an investment.
All right, Feroze, I want your view on this. The asset allocation, where does both these two asset classes fit in?
Like Sir said, 62% of Indian HNI money is in real estate. If we collected everybody's balance sheets, that would be the average. Real estate, in our opinion, for the next 4 years can't do well. Of course, Hyderabad as a micro market, since it has not done well for the last 10 years, has shown signs of recovery for the last 2 years. Barring that, what is happening with real estate is it can't do well for all the points which you already know. Let me add a couple of points which might be deterrents for its progress. In real estate, what used to happen is bull markets are long, bear markets are long because of Section 54. When a person doubles his money in real estate, when he sells the house, if he reinvests it, he gets a tax rebate. So what used to happen when the bull run was there, the guy was making money, the lady was making money, he was selling one house and we buy another house, so the money was circulating in real estate. Now what has happened is money is not being made. Now in Bombay you take any house bought in the last 10 years, 8 years, has not made substantial returns after indexation. So guy, when he sells the apartment, if he gets a buyer, he has not made any profits, so there is zero taxation. So he takes the money and does not reinvest in real estate. So Section 54 means that the money which is coming out is also not getting re-entered. Forget fresh money coming in.
Right.
So that's one strong reason. And the second strong reason why central business district, जो city के center की properties हैं, उसके दाम बढ़ नहीं सकते. Outskirts can still increase because of infrastructure development. So these are the two unique points. If your property is in central business district, the age-old saying location, location, location. Location itself could be your damaging point. So these are the two reasons why real estate 4 years cannot generate money. After 4 years you will be able to sell it at the same price, which is as good as losing 30-40% of its value because of time value. Second, gold. Now that we are on the topic, like Rathiji said, gold is not a good investment because it gives you return for 1 year. 1 year, 26% return. Right now, if you are speaking of long-term investing, then gold will not give you returns greater than debt, and that's what data says. If you have bars and coins, please convert them into sovereign gold bonds because it gives you tax-free gains. Second, you get 2.5% dividend or interest every year.
But Feroze, I've always heard you talk about 5-6 product categories. Haven't you ever thought about PMS, AIFs, wine funds, art funds?
PMS is a very popular product, right? It has risen from wherever it was. Usme, there were uske 3-4 सालों में, from April 2015 till now, the assets of PMS have gone up 30 times. In 20 years industry, first 15 years, there was nobody touching it. Last 4 years, so much money has come in that it is now 3 lakh crore. Most PMSs have a standard deviation or risk number of 20. AIFs and PE funds. I had done the first PE fund in 2006, and 2006 India rate was one of the first funds. Okay, all these funds I did for my clients, and then in 2010 concluded that this is not a good idea and came out of them.
And to add, what he said, two important factors for any decision is obviously taxation, as he said. Now, if you look at PMS, the taxation of PMS versus mutual fund, I think very clearly, mutual fund is a better option than PMS. And second is liquidity also. In many decision making, like PE funds, as he said, what is the liquidity? Can you exit at the time you want to exit? So I think all these considerations must go into your strategy planning. And I think, as Feroze explained, so these are the things which I thought can add to what Feroze said.
Okay, all right. Feroze, what should be, someone's debt strategy in someone's portfolio?
Correct. Debt is the third biggest asset class. Debt is deposits and debt funds. In our opinion, for the last 6-7 years, we have stayed away from funds which are rated AAA, because marketing a AAA fund is very easy.
Yeah.
AAA has been something which we are not comfortable with because there are fewer AAA companies, right? And in India also AAA has been very generously given. US has only 2 AAA companies. India has 100 AAA companies. So our debt strategy has been to buy 8 non-AAA funds, and that has resulted in far better returns. So that should be the strategy, rather than going with the herd mentality. When companies go bankrupt, buy only AAA. In fact, the problem is AAA went bankrupt.
Well, it's time now. We'll slip into a short break, but don't go anywhere. We'll be back with the Q&A session. Welcome back. You're tuned in to Investing Edge. And with us, we have Mr. Anand Rathi, Chairman of the Anand Rathi Group, as well as Mr. Feroze Azeez, the Deputy CEO of Anand Rathi Financial Services. One question
from ladies, I think.
We have a lady out there.
Hello, this is Navya, Finance Executive from Zia Sports and Entertainment. I have a question, that is, does it make a sense to focus all the investments in India looking at the current scenario?
Okay, I think our rule of the game was that the simple questions would be answered by me, difficult by... I think this is simple, so I can answer it. I think, you know, now, where do you want to invest money? Where the growth opportunities are greater. Today, I think, if you look at the world scenario, in today's situation, in spite of our GDP coming down, today our economy looks to be, you know, far better placed than most other countries. And therefore, in fact, there is a lot of money coming into India. And therefore, people who are making money in India, our view is that it's better to invest in India because the type of return which you can get here, 14, 15%, you can't get at other places, even net of, even if you, you know, invest in other places, if net of your devaluation also, if you get 8, 9% here, is better than anywhere else you can get. So our recommendation is that we want more people, you know, even Indians staying outside India to come and invest in India, rather than going the other way around. Okay? Last question we'll have.
All right, let's take another quick query. I had invested in a fund called India REIT 4. I have already lost a lot of money. Feroze, can you tell the way forward on this? This is an important query,
Yes.
Feroze.
Very good. So I think India REIT, when I mentioned the name, it must have struck somebody's chord. So I think India REIT 4 in specific, because India REIT 4, for any example, this could be extrapolated to anything. Now this India REIT 4 had about 4, 5 investments, 6 investments. It has paid back, if I'm not wrong, 110% of the 100 you paid. So in 9 years, 10 years, it started in 2009, if I'm not wrong. It is finished 10 years. You paid 100, you got 110 back. 113, 14 back. 3% is the IRR. Now, the key, which can be relevant to all of us, and I'm sure most of us would not have invested in India REIT 4, but this, what I'm going to say, could be helpful. Not just for India REIT 4. Now, whatever are the, so there are 2 companies or 3 companies in this which have gone for a litigation. So still almost about 30% of your money is still on litigation. Now, can't do much about it, then pray, right? But you can definitely take a tax advantage as per Section 48 and Section 73. By which I mean a person who has bought India REIT 4, if he has put 100 rupees, he has got 110 back, he still expects 30 rupees to come back. If you went to income tax and told, I have 30 rupees is not coming back to me, and 30 rupees, if I inflate it, matlab 30 rupees 10 years back and 30 rupees today is different. That's called indexation.
Yes.
The value of the 30 is 40 rupees today. So if you transferred it from your name to your spouse's name, you will be able to take this 40 rupees as a long-term capital loss. With this 40 rupees, you can set it off against real estate gain, you can set it off against structure product gain. If any Anand Rathi customer is there, it's bound to be that there will be structure products in the portfolio. Structure products also will have surcharge now, right, if you're in the highest. So you can use this 40 rupees to set off tax. जो पैसे डूबे, right, 30 रुपए डूब गए हैं, उसमें से 10 रुपए का tax benefit तो ले लो, right? That's the least an advisor should do. And if your advisor, after making 4, 5, 10% commission on India REIT 4 and has not even told you to transfer and not facilitated the transfer to get you Section 48 and Section 73 benefit, then it is a very, very sad state of affairs. That means the person is not feeling for the money. It should hurt you when your clients lost money. Then you have to use your might. So taxation as an objective, not written down. Most people don't even have their pre-tax and post-tax returns measured. If you ask a client, what is your last 5 years pre-tax return, post-tax return, it is not measured. The biggest traders don't have it measured, post-tax and pre-tax. Not the biggest traders, most traders also don't have, who are doing this for a living. They don't have a pre-tax. Broking outfits don't give pre-tax and post-tax returns on their statements. So point I'm making is, please put that as an objective. This was only one example I'm saying. Any fund which you have bought, which is a PE fund, real estate fund, or some fund, can use this benefit. If there is no performance, at least get some tax credits, which you can use in the next 8 years. It's not like you have to use it this year.
Yeah.
Right? This year there are no profits, so you will not end up using it, right? So you might use it any time in the next 8 years. And
set it up.
So that's what I would do if I'm an India REIT 4 investor. And if your advisor has not told you, he doesn't deserve to be your advisor, because I very passionately feel about it.
Any questions from back there? Okay. Yes, sir.
Yes, sir.
In the introductory talk, Mr. Rathi had said, the house you live in is, consumption. Now, when I was discussing with my, the team for my investment, I asked them that now you have the concept of a reverse mortgage. Suppose, and why is it that, and then I asked them, I said, can you let me know whether I can use a reverse mortgage so that I can generate income on the house which I'm staying? Because right now, you are just written it off as a consumption, no return from it.
Yeah.
Now, what is your opinion on that?
I'll take this. So reverse mortgage, sir, in India doesn't work. Why, I'll tell you. The concept of reverse mortgage is on the basis of lower interest rate. Now, for example, what is reverse mortgage for people, if I fill them in, if they're not aware, is globally what happens is, let's assume I'm a retired couple with my wife. I have a house. I know that once both of us are no more, we don't need the house. So what they do is, they borrow the money of the value of the house today itself, discounted value, and say when both of us are no more, the house belongs to the bank. That's called reverse mortgage. You have bought the house, but you're borrowing on the house with a conditionality that when I'm no more, the house is the bank, belongs to the bank, and the bank will auction it. Now, when you discount, let's assume my house value is 10 crore rupees today, or $1 million. They calculate what is my life expected. And then they figure out that if we both are going to live for 15 years, they will discount the 10 crore rupees, saying that ye 15 saal baad chale jayenge. So $1 million or 7 crore rupees in Indian rupees, they will discount it for 15 years and today itself give you 3.5 crore rupees, for example. Or 4 crore rupees and say, now you can stay in this house. I have given you this house. I have given you 4 crore rupees. You can live in the house. And instead of passing it on to the children, you will pass it on to the bank when you're no more. So when you're discounting for 15 years at 2% interest rate, then the value is still substantive. But if there is a 10 crore house, you discount it for 20 years. At 10.5%, the value he will give me is only 50 lakhs, 70 lakhs, 1 crore. Do you understand? So reverse mortgage, I'll give away my house and I'll get only 1 crore. I would rather have that. So for reverse mortgage to work, interest rates, because it works on a discounting concept of 15, 20 years, the value of the mortgage is so low that I will not, मैं अपना घर नाम नहीं करूँगा बैंक के, because 20 साल बाद value of 10 crore apartment could be actually 30 crores, but he's still given me 1 crore and he has taken the house. Will I give away my house, which could potentially be a 30 crore asset for 1 crore rupees? So that's why reverse mortgage has not taken shape in India.
Okay, all right. Thanks so much, Mr. Rathi, as well as Feroze, for joining in. And thank you all for joining us on this edition of Investing Edge. You stay tuned to CNBC TV 18.